Hey everyone, Sean Taggy here, Chief Operating Officer and partner of Memphis Investment Properties. So today I'm going to be going over multifamily investing strategies. So first off, a multifamily asset is considered, a duplex, triplex, fourplex. Those are all kind of the small multifamilies. 5 units and more is what I'm really discussing. And in our strategy, we actually purchase 100-unit apartment complexes plus here in Memphis. We've acquired over 600 doors in the past 3 years. One of them we've sold, 2 others we're ready to start selling. A couple others we just bought and are in the almost to refinance days, and one we just bought and is being renovated right now, and we're adding value to it. So why don't I first just kind of go over the multifamily investing strategies, okay? So I'm going to go from kind of like least risky to the most, well, depending on your strategy and everything like that, to the most risky or the more work intensive. So kind of the more easier way to go about it is to just buy a property that is stabilized. Okay, so what I mean by stabilized is there's 100 units out there and it's rolling. It's already been renovated or brand new, or it's in great shape, right? It's well managed. There's professional property management in place, most likely, and it is 90% plus occupied, preferably even 95, 97% occupied. And then there's a D on there, not as stabilized. So 90% plus occupied. Okay, so that one's kind of easy. It's like it's more of a passive way to invest. All the renovation work is pretty much done. There's just light renovations as the units get turned over, as a tenant moves out, change the locks, do a clean, some minor patch up, right? Not a lot of management needed there, a lot of effort on you as the investor if you're personally buying this yourself. So that is one way. So with stabilized, you typically, though, buying it, you're probably going to buy it at top of market value, meaning at probably a lower cap rate. And the reason why a lower cap rate, that just means the investors that are buying it consider it to be less risky. That's kind of one thing you can gauge cap rates off of, is that the lower the cap rate, the less risky the investment is what investors feel, right? Because that means they're willing to take a lower return on investment, okay? And so therefore, it's because they're just hedging against risk. Where if the cap rate is higher, investors are typically thinking, well, this is a little bit more riskier, so therefore I would want a higher reward, a higher return on investment to that. So these ones are usually at lower cap rates, ready to go. You probably don't have a lot of equity or a lot of value, can keep increasing that. Like rents are probably already at top of market value, can just be increased with natural rent appreciation and everything like that. Not a bad way to go about it too, though, right? If you're just wanting cash flow, this might be cash flow in day one, not a lot of work. Just depends on your investment strategy, and we actually consider all of these strategies ourselves. So another one is called value add. So a value add strategy is where maybe this property has a little bit of deferred repairs on it, deferred maintenance, deferred CapEx, capital expenditures, and maybe the owner hasn't been managing it well, hasn't been putting in the necessary repairs to get full market rents. Maybe it's a little bit below market rent. Maybe rents are $800 a month and they can be $850 or $900 or $1,000, or I've seen way more than that. I've seen could be $1,200, but it might need more repairs to get it up there, right? Maybe it's old formica countertops and needs new granite countertops and backsplashes. So you can value add either, you can do a light, there's a light value add or there's a heavy value add. Okay, depending on the market and the strategy. A light value add might already be 90% occupied plus, and you're just small $50 to $100 increases in rents, okay, and not too much on the exterior needs fixed, right? Then there is heavy value add, where you're buying this 0 to 90% occupied, okay, and rents can go up $100 to $400 a month per each unit rent, okay? That's a really heavy value add, and maybe it's completely distressed, right? So distressed. People actually consider distressed 90% or below occupied. Us, like that's nothing for us. We buy, usually our multifamilies, we're buying them 50, 60% occupied, and those are extremely distressed, okay? So pros and cons to that, right? You might be thinking, depending on your experience level and also how deep your pockets are, if you have good reserves and know what you're doing, if you know the market really well, that's really where the local market players are in here. Most of the big hedge funds and kind of other regional players are going either light value add or stabilized. The local players are usually taking on these unless it's like a real big fund that they specialize in that. So the cons of this is, right, you're buying something distressed. It's distressed for a reason. Usually that is, though, what we're finding is the owner doesn't have money to fix it up. They're not reinvesting into their asset, and also the owner is mismanaging the asset, meaning their property manager on site or themselves as the manager aren't doing a good job. They have something else going on, another business, and they're barely focusing on that asset. And they just don't, and then they don't have the knowledge or bandwidth to renovate this. So for us, that's kind of what we're focusing on, are these light to heavy. We also are doing stabilized now. Just depends on the investment strategy. But with these heavy value adds, we go in and completely turn them around. We're buying them pretty cheap for pennies on the dollar of what they could be worth, and really raising occupancy, raising rents a bunch per unit, and creating, actually really kind of redeveloping the neighborhood. Right? Really putting a mark on the neighborhood, making it nice and new, a nice, clean, safe for these tenants to rent. And what we're seeing is in this area is tenants are loving it. It's turning it around. The ones that are paying and all that, we'll renovate all the units that they're not occupied in, but then once when everything's renovated, we say, hey, we'd like to renovate your unit. You can move into one that's renovated, or we'll raise your rents up to market value. And they want to stay at the asset and stay there, because they're seeing the good turnaround on the apartment complex. They're seeing that there's a good property manager there, and they're actually managing it like it should be and holding tenants accountable, making sure they're doing the right things on that property and keeping it clean and safe. This also, though, could be riskier depending on your strategy. To us, it's not quite as much because we've done it several times, but to a new person, I would not go start out with a heavy value add. If you're looking to actively invest and buy your own type of apartment complex, I'd go stabilized or a light value add. Because this, even if, most multifamily assets, when you buy it, it can get down to 80, 70, even 60% occupied, and you can still at least break even and pay the mortgage and the expenses. So this, you might have 1 to 2 years of negative cash flow, but you will get a huge upside on your returns, right? With the you're basically flipping it, either to refinance or flip it. So this is like you can do a full-on flip with it. These ones take probably 5 years or 10 years to actually be worth selling it. So that's another con sometimes about stabilized, depending on the market. It might take a little longer of holding it, but you'll have cash flow day one. This, you could in 1 to 2 years, 3 years, depending how quick you are, you could go ahead and sell it and get a great return. We did one where we've gotten a 50% IRR on flipping this, and we have others we're projected at 30, 40% IRRs. So we're talking some big risk reward here, where most people are looking at 10 to 20% internal rate of return over a 3 to 7 to 10 year hold on light and stabilized assets. So that is the multifamily investing strategies. Stabilized value add, a light value add, or a heavy value add, working on a distressed property. And so when this gets up to here, 90, 95% plus occupied, you can go and refinance it, pull almost all the money you put into this out, or sell it and get all your money that you put into it plus a great return. So there are some multifamily investing strategies that we are actually personally working on at Memphis Investment Properties. We actually do have opportunities available for investors to invest alongside with us. We did our first two with our own money, just to make sure we made mistakes on our own money first, learned a lot, and actually proved a lot, got some great returns. We now have opened up this opportunity to other investors. You must be an accredited investor only, though, and we have that definition of what an accredited investor. Anyways, if you are interested, we have a link. You can grab that in the show notes or on our website, memphisinvestmentproperties.net. Click on the multifamily tab. Fill in your information if you're an accredited investor, and you can get on the list to check out our next value, heavy, light, or stabilized asset that we have available. We're trying to buy one a quarter. or so here in Memphis and within a day's drive of Memphis cities. So yeah, guys, pretty interesting stuff. You can invest alongside with us. We put a significant amount of our own capital into all of these deals that we'll do, just to show we're investing alongside with you. And we're in there with the lows or the highs with you, and it's because we also believe in it. And it's a great investment strategy and tax advantage and investment vehicle for us. So thank you so much, guys. Let me know if you have any questions in the show notes. Be happy to help you out. Have a good one.